Hey, market chameleons. Thanks for joining us for the pre-market show. How are you doing this morning, D?
Good. Good morning, everybody. Good morning, Will. How are you?
Great, great. Thanks for joining us, everyone. Hopefully you can hear us. Why don't we just get started right with the disclaimer? What do you think, D?
Yeah, definitely. We'll get that out of the way real quick. And keep in mind, everyone, Market Chameleon, Will and I, were not investment advisors or broker dealers. If you need professional advice, then go seek out a registered investment advisor or call your broker. We're just sharing ideas. There's the disclaimer really quickly.
Awesome job with the disclaimer. Listen, before we get started, full bore, if you've seen the screen and it's a little fuzzy, there is a little bit of a problem between Zoom and YouTube Live. So I'm sending a link so you can come into the Zoom meeting with us if you are seeing something fuzzy. Put all your questions in the YouTube chat and I will try to get them this morning. D, we have tons of people on the chat saying good morning. Good morning, everyone. Thanks for coming.
Good morning, everybody.
D, why don't you get started? What's going on in the market?
Okay, so as usual, we'll just go over what's moving in the pre-market hours. And again, if you're joining us for the first time, this is the pre-market report. Stocks that are trading in pre-market, you see the most active stocks, the biggest percentage gainers, biggest percentage decliners. And actually, one thing I did want to show before we go into looking at some of these movers and analyzing the price action is that if you are just a lot of people like to trade on news and events and looking for movers on news. And you could do this either in a pre-market or even during the daytime. So here we have a news scanner and I'll show you how that works. So here you just have the news scrolling in. These are press releases that are coming out. That's how companies usually communicate any important information like earnings, dividends, or any type of information. They'll issue a press release and they'll issue a press release, and these are the press releases that are coming out for different companies, and these are the stock reactions. So I'm going to just click on like pre-market, and we could look at like bullish movers, so you could just see what's moving in the pre-market with both. You know, these are biggest percentage gainers right now. These are the news, so you could just quickly click on that, read the story, see what's going on. Bearish movers, you could do the same thing. Sort it really quickly, see what the news is. You could also do that by your watch list. So if you have a watch list, just look through all the stocks in your watch list. Bullish movers, really fast. It gets you anything that's moving and any news that's coming out in the press releases. But let's go back to that pre-market report, what we usually do. And I'm just going to go to the ones that are at the top of the biggest gainers. And we see here, like we usually see, it's like some of these lower cap stocks. We have SSNT that's up 376% on 2.3 million shares. ATHE that's up 185% on 6.9 million shares. There is some news here on the day. I'm going to press on SSNT and just take a look at what's going on with this stock. We see close $2.72. Right now in the pre-market is trading $12.94, up 375%. That biggest VWAP bar right now trading between $12.50, $13.86, 1.2 million shares. Here's the pre-market chart, so you can see how that stock has been behaving. The high low in a pre-market as low as $2.89, right where it opened, 7:30 when the news came out, popped as high as $19.89. We see 52-week range, $1.62, 825. So that's well above the 52-week high right now in the pre-market hours. If you wanted to read that catalyst, I'm not going to go into the news or what that is. Let's just analyze it from a price action analysis here. Let's take a look at its historical big gap moves to the upside and what the stock tended to do after a big gap move. So here, this is in the last 3 years, these are the biggest upside gap moves in SSNT. So the 12 biggest gap moves in the last 3 years, we see the average is 13.1%. I see a high here of 19.9%. So this way above anything we've seen in history. Just using these as our sample from when it did that big opening gap move from the open to the high, the average stretch was 19%. We see here that though 50% of the time the opening was the high, so you see these zeros, that means right from the open that was the high, and then it tended to move lower. From the open to the low, average move was negative 7.5%. When historically, at least when it had a big gap move, that same day from the open to the drift, 83% of the time it drifted lower by the close for an average loss of negative 3.7%. Again, today has some major news. You want to take a look at that. You know, I do see here on one of these days, August 27th, it opened up 10%, but to the high of the day, it was up as much as 198%. Coming out, we see the next day, 75% of the time it was higher, and here kind of a little bit of a mixed bag leading out one day after. So that's a really quick SSNT price action analysis. Let's take a look at the next one, ATHE. And now this one I think is a biotech company. We do see a lot of biotechs popping up in there in the pre-markets when they're announcing any type of news with their clinical trials, or I would see what this is. Here's another something over here about their lead drug here. Anyway, here are the catalyst news down here. So let's just take a look at this stock. Closed at $1.35. Now in the pre-market's trading $3.75, up 177% on 7.3 million shares. The high low of the year prior to today's moves, 28 cents, $2.35. So we're well above that 52-week high. Here's the range in the pre-market, $1.65, $6.12. Very big, wide range, as you can see here. Right now, pre-market VWAP, $4.69. The biggest VWAP bar that I see, 2.2, almost 2.3 million shares traded between $4.27 to $4.59. So now we're below that, the last price below that. I'm going to take a look at the historical gap moves in this stock. Once again, this is looking at the last 3 years, taking the biggest 12 gap moves to the upside, and let's see what happened those days. So here, the average gap move of these 12 observations is 31.1. I see a high here of 151% here on June 30th. You know, so this today is above even that. After the open, from the open to the high, the average move was 15.2% here. From the open to the low, the average move was 19.3%, a little bit more biased towards the downside. We see a couple here, 25% of the time, that opening price was the high of the day. From the open to the close price, it tended to drift lower 83% of the time for a negative 9.8% return. And we see here some of these were even recent, June 30th, July 1st, so had a couple gap moves in the most recent history. Here, coming out of it the next day, we see that a lot of, more often than not, it was down on the day, but some of them had some big moves, so the average returns were high. So even though more often than not, it moved lower, we see that this stock can be very volatile and have very explosive moves to the upside, like here. So that's really quickly on this stock. One thing I wanted to look at is, well, since a lot of biotech stocks pop in there with very big moves, let's just see in the last 2 weeks what's been going on with those biotech stocks that gapped up in the morning. So down here, this is a report of all the gap movers in the last 2 weeks and what they did after the opening bell from opening to 10 a.m., from opening to the close of the day. And we could see here that if we took all the gap without putting any filters in, all the upside gap movers, 46% of those from 9 a.m. to 10 a.m. were higher, 53% were lower, with an average negative return of negative 0.2%. From those same group, from the opening to the close, 49% of them were higher from that opening price, 51% were lower, for an average return of negative 0.1%. So let's see, out of that whole group, what if we just filtered out biotech stocks that had very large gaps? I'm going to go over here, look at biotech stocks. So now we just filtered out biotech stocks, so we can see there's a difference here. Let's look at biotech stocks that had really high gap moves. And since a lot of them are lower cap stocks, let's see how those did. So I'm going to just go to under 100 million, under 100 million in market cap. So we see here there's 6 of those in here, and this is how they tended to do. So compared to all of them, 46% were higher versus those biotechs with big gap moves under 100 million, 50% were higher by 10 a.m. 50% were lower. The average return was 16.7%. So we can see here that some of them, this is by 10 a.m. they gapped up. That's the opening price, went higher by 10 a.m. This being another 45%. Here's another big one, opened up 81%, and then continued to 10 a.m. gained another 107%. So what this is saying is some of those by 10 a.m. right at the open kind of continued their rally. Well, 50-50, but the ones that continued, we could see had very explosive upside moves. However, by the close of the day, what we see is that only 17% of them ended up being higher from the opening price. 83% of them ended up being lower from that opening price over here, for an average loss of 8.2%. So just have that, as a historical perspective in this type of a group. If you're playing in these biotech stocks, that's your kind of your historical reference in the last 2 weeks. Will, unless you have the pre-market, anything specifically on that pre-market, what I'll do is move on to the earnings and maybe show like a different type of options related report.
Nope, that's great, D. Thanks.
Okay. I'm going to go here. Let's just take a look at what's coming up in the earnings and what the options are expecting, the moves. So I'm going to go to, these are coming up in the next 2 weeks. Let's look for stocks that have average daily option volume of 10,000 or more, because we're going to kind of analyze this from the perspective of the anticipated move. And yeah, so let's see what pops up here. I see here, I think we said we're going to mention WYNN. So that's, or we mentioned WYNN before, TWLO. So that right now is expecting a up or down move of 10.8%. Remember, we're looking at the option straddle, buying a call, buying a put at the money. It's anticipated move of 10.8% in either direction. That compares to an actual 4-quarter average move in absolute terms of 14.5% and 12-quarter average move of 14.8%. So we could see here right now that's 3.7% below the historical averages on the 4-quarter average, 3.9% below the 12-quarter historical average. We see in the last 12 quarters, the high move was 39.6%. Another one we talked about was WYNN. That's coming up tonight after the market close, anticipating a 7.6% move. That compares to 4-quarter average move of 2.5%, 12-quarter average historical move of 4.6%, with a high move of 13.1. Beyond Meat, we're talking about that one also yesterday. Right now, as of yesterday's close, that straddle's implying a 13.8% move in either direction. That's compared to a 4-quarter historical average move of 19%. So that's right there, 5.2% below that 4-quarter average. and a 12-quarter historical average move of 23.1% with a high move of 39.3. Also, we have Wayfair. We talked about Disney. That's anticipated 5% move. That's 2.2% over the 4-quarter average, 2.8% above the 12-quarter average as of yesterday's close. Wayfair here, 14.4%. I know, look, this sector has been doing really well lately, especially with people shopping from online.
Yeah, it's like the opposite of the casino sector, right? People
It's
are
like the opposite.
having a hard time getting into the casinos, but they're ordering stuff for their homes like wildfire.
Yeah, so the online retailers have actually been doing really well in this environment. And anybody doing just exclusively, I guess, online, those companies have been doing really well. And this, I know this stock's been kind of on fire too, because I saw, it was one of the biggest percentage gainers in the last month. But right now,
someone online was on this screen was looking like they wanted to see in TWLO what's happened to previous earnings, like charting against, like seeing the vol crush.
Okay.
What's an easy way to get to that? The person was mentioning love to see it on this screen, like be able to get to it quickly. I'm just wondering, is there
just like pop it right in the screen? I could talk to a developer. I don't right now. I think you have to. I'll show you how to do it now.
Yeah, just migrate over from one. Maybe do Wayfair or TWLO or something where we can see migration over.
Okay, so well, at least from Wayfair's perspective, that's anticipating 14.4% move in either direction. That's coming out tomorrow after the market close. That's 1% above the 4-quarter average move, 0.5% above that 12-quarter average historical move. Remember, in absolute terms, the high move of 27.9%. So right now, let me see. Let me go from here to TWLO, see what happens. I think this just takes me to the summary page. So if you click on that, that takes you to this page. So if you click on a symbol, it'll take you to that page we're talking about. I think this is the page she was talking about. So if you just click on that symbol, it pops up a new window. So you could just kind of toggle like this. But here's TWLO historical earnings moves. So we see here that it was, so it overestimated the move 50% of the time, underestimated the move 50% of the time. So it was like 50-50. The average of the implied moves in the last 12 quarters was 11.4% in either direction versus an actual 14.8. So you could see that those straddles were actually pretty profitable if you did them all 12 quarters. That's like a 3.4% differential. So looking at this over here, these bars are what the market was anticipating, up or down. That's why you see both directions. The green is the actual move to the upside. Red is the actual move to the downside. So here, see, as May 6th example, the implied move was 9.2% in either direction. That stock was up 39.6% after reported earnings. So way blew out that straddle. So if you're along that straddle, it's extremely profitable. And it looks to me like at least the moves to the upside, looking at those greens, were much more explosive than to the downside from a historical perspective. So that looks like, and sometimes people, instead of playing the straddle, they could just play the call. They're like, I don't care, I'm just going to play the call side, especially if you're bullish. But you could see here how explosive those moves have been historically. If you did the straddle, last 12 quarters, it was a winner 56% of the time, bought it the day before, closed it out the day after earnings for an average gain of 37%. Long the strangle, that's if you're buying the out of the money call and out of the money put at the same time, that was a winner 36% of the time, but the average gain was 53%. That's because of those big explosive moves. So those wings gained a lot. Credit iron butterfly, that was profitable 44% of the time, but the average loss was negative 24%. credit iron condor that was profitable 55% of the time, but for an average gain of only 2%. Let's take a look at what the implied volatility did in those options. So we see here that historically we're looking at a 30-day constant maturity. So not the near-term month, but 30 days out, 30 trading days out. On average, the implied volatility got crushed 26% from the day before earnings to the day after. The average implied volatility the day before was 64. The day after, the average implied volatility was 46.9 for an average 26% volatility crush. 5 days after the earnings were released, the average 30-day implied volatility was 45.2. So let's just take a look here. This is how it lines up 2 days before. So we're right now 2 days before. Right now, 67.8. The average is 65, so close to that, with a high of 84.6, low 55.7. This is the 1 day before average, 64, high of 78.5, low 55.3. This is the average day after, 46.9, high of 66.6, low 38.8. This is 5 days after. So this is how the implied volatility tended to behave historically around the earnings. What was the other side? Did you have another symbol that you wanted to look at? Well, or somebody was asking for, or that was it, the TWLO.
Well, they wanted to see the Wayfair too, the W.
Okay, let's take a look at that. So I'm just gonna go from here. So here's Wayfair, how that tended to behave. Let's see here. So we see that the market's overestimated to move 42% of the time. The average of the implied moves was 13.6%. That's compared to actual average move of 13.9. So this one here, actually that straddle tended to be a little bit priced on average. So you can see here like a 0.3% differential. I see some of these moves. Here we go, like some of these moves to the upside were explosive. So we got, May 5th, it reported earnings. The move was 23.7% to the upside. That's compared to 15.9% move in either direction implied by the options market. We have another one here up 27.9% versus 12% implied move. We broke down a couple times to the downside. That exceeded the expected move, down 18.6% versus an implied move of 17.5. So you could see here that stock has had a good amount of times that it blew through that straddle, or the price of the straddle. Let me just take a look real quick at the implied vols, what they tended to do. Again, this is on a 30-day constant maturity option. So we see here that on average, the implied volatility declined by 31% day after earnings. Day before earnings, the average implied volatility was 78.6. Day after, the implied volatility was 55.2. 5 days after, the implied volatility continued to decline a little bit more to 52.4. Here's where we're at right now. 2 days before, it's 91. On average, it's been 79.4, high of 120.8, low 61.7. So that's a really quick overview of the Wayfair historicals.
We're getting a lot of questions about doing overviews. Do you mind taking a couple more? Doing the exact same thing. TWLO. Someone was looking at TWLO.
Okay, sure. Do you mean like a different symbol?
Yeah, just the exact same thing you just did for Wayfair. They want to look at I think TWLO was one, and
I think then I just do that one. Well,
yeah,
that's the one I just did.
You did.
Huh?
Ahmed, you're gonna have to go back. Dima just did that one. That's what I thought. The other was ZM. I think that may be Zoom, the product we're on right now.
Zoom, this one. So I'm on Wayfair now. So let's take a look at Zoom. So that one, I don't think that's I don't have an earnings that's coming up for for Zoom. I just have an estimate here. Let me take a look, but I don't
Probably
think it.
may not be a lot of data either.
Yeah, I don't think there's a lot of data. The last one was on June 2nd, it reported. So we don't have any, but you could see here that it's a relatively new stock, so there's not a lot of data. We have a smaller sample, but that one already, I think, reported earnings on June 2nd. So that's not coming up anytime soon. I had another report I was going to show, unless you have a specific stock, you know, that's reporting earnings well.
Nope, that's good.
Okay, so this is one, it's more for options traders, and really options traders, there are different types of options trades around, like a straddle or out of the money call or out of the money put. One is you could just buy it and kind of hold it. You know, we use like a weekly benchmark. If you did it from Monday to Friday, what happened to those options? So you could buy it and hold it. Another way is you could just hedge it, hedge the delta and hold it. And then there's another way where more professional traders, they'll do a option, hedge the delta, and then at the end of the day, or however you want, they'll trade their gamma. In other words, they'll re-hedge the deltas every day, and this way they're scalping. It's called scalping realized volatility versus implied volatility, which is the way the options models were built, that you're going to be actually trading the volatility in that direction. So let's take a look at this report over here and see what we're talking about. So I'm just going to filter out, for example, let's just look at Apple, right? Now here, so we have here, this is the straddle. This is a 25 delta call, which is basically an upside call, you know, an out of the money call with a reference price of 25 delta. This is a 25 delta put, which is a downside put, 25 delta. And we split it up into, what if you just put that on Monday, took it off on Friday? How did that perform? If you did that every week for, right now I have it set to the last 12 weeks. You could change that kind of up here. What if, you know, you did that straddle, but the straddle isn't exactly delta neutral. You hedged it just to be delta neutral, so it didn't matter which direction it went. And then what if you re-hedged it every day? So options have a gamma, they move, you re-hedge it, they move again, you re-hedge it. So you're trading stock against your options. So let's see which strategy did the best. So here, this is the win rate here. This is the average return in the last 12 weeks. Remember, you did it on Monday, took that strategy off on Friday. This is the median return. Here we have the standard deviation of those returns. So, you know, if you have a high standard deviation, that means your returns were all over the place. You know, you could get a negative, very big negative return, very big high positive return. So the standard deviation just tells you how those returns vary around the average. This is your worst return, your best return, and then this is the Sharpe, taking your average returns divided by standard deviation. So here, if we just use Apple as an example, here I'm seeing that the best return on average was just buying the 25 delta call, but that was only a winner 33% of the time. So in the last 12 quarters, you only were profitable 1/3 of the time, but the average return was 40%. Again, that's Apple, and it had an earnings, so keep that in mind. It had that explosive move. If you did the call, the next one, but you hedged that delta, in other words, whatever the delta was in the call, you offset that delta by shorting stock, right? So you're delta neutral and you re-hedge that delta. So that was a winner 50% of the time. You can see that standard deviation is a little bit lower. 201, still very high, versus 267. So the frequency of wins increased a little bit from 33% to 50%, but your average returns are lower, 23% on average versus 40%, of course. And your Sharpe was better just doing the upside calls. Again, this is just comparing a strategy of what if I just did the option, did nothing from Monday to Friday, versus what if I re-hedge those deltas every day and scalp realized volatility in the stock versus the implied volatility in the options. So a fast way to compare those strategies. And we just actually updated this report. That's why I thought it'd be interesting to show it today. So we're kind of running up against time. Will, if you have questions.
Well, we had one question, and actually we discussed a little bit about these ultras last night. One of a very active person on the YouTube chat this morning, Thomas, was talking about a rotation into the natural gas stocks, and he was looking at BOIL. And if you look at BOIL, it's an ultra long.
Like an OIL. What is it?
BOIL in natural gas. And people with these ultras, people just have to be, careful. Just their structure can, it's like a negative trade when you don't want to hold these things long term, in my opinion.
Right. So this is is this one an ultra oil? I'm not sure if it is.
It looks like it's a double. UNG's the true ETF, which the ETFs have their own things you can be aware of natural gas.
Okay. Yeah, I don't know if this one is I mean, at least it's not describing it like that in the in its name. But if you're trading, right, the problem with the way the leverage products are structured is that they have this negative decay, and that's because they're following simple returns. So when we look at like options or financial products, we're usually pricing it in log returns. And what I mean by log returns is that if a stock goes from 100 to 110 and back to 100, it's kind of like a break even, right? You're back to the same spot. Simple returns aren't like that. So, if you go from 100 to 110, that's a 10% gain. But from 110 to 100, back to 100, that's losing less than 10%, right? So the way they're tracking it by simple returns gives it this negative decay. They're not using log returns, they're using simple returns. So what happens is it's like a negative decay over time. So if you're using those, be very careful. I think the only way they could be useful is a very short term. Like if you think today or tomorrow something's going to move really big and you want to get out, that's probably the only way to potentially use them. I would be scared to hold them very long term. So I guess what I was pointing out is if you have your underlying going from 100 to 110, and it goes from 110 back to 100, and you have a leverage product that's mimicking that, when it goes back to 100, you're actually not breaking even on the leverage product. It's going to be below where you started. That's how it's going to reset every day.
Very cool. Very cool. Well, there's an insight into the ultras. Be careful out there, everybody. Dima, great job. Thanks everyone for joining us. Remember to follow us, subscribe on YouTube, give us a thumbs up. That's always helpful. Dima, great job. Any parting words?
Thank you. Well, no, thank you everybody for joining us. It's been great. We haven't been even doing it that long, maybe like on week 2 or a little bit longer, but it's been great. Thank you for watching. Thank you for all the emails and sharing your ideas. Hopefully you guys have a great trading day, and we'll see you tomorrow.
Hey, have a safe trading day, everyone. We'll see you tomorrow.
Thanks, everyone.
Bye.
Bye.